Good morning, everyone. Welcome to this roundup of global events for the week. And gosh, what a week it was with an incredible sell-off started in the European bond market and basically swept around the world and was really felt here with a very heavy sell-off of Australian bonds and hence a big rise in the yield at the same time that the RBA is lowering the cash rate. Can't remember ever having seen anything remotely like it. So quite an extraordinary week. Let's have a look at what's gone on around the world. Last week I posed the question whether the old adage of sell in May and go away for 3 or 4 months was worth adhering to this year. And certainly in America, I think when you look at the chart and you look at the price action, the answer quite categorically is no. In fact, I think the American market is bordering on a breakout to the upside. But the answer in Australia is quite probably yes. And we saw a really severe sell-off in the Australian market, particularly in our banks. So if you look over the last 3 or 4 years, our market has been driven higher by what's called the high yield carry trade. So overseas money has been flooding into Australia to buy our banks and other high yielding stocks like Telstra, Wesfarmers, etc., because the yields were just so attractive. And that pushed the valuations of those stocks to in my opinion, silly levels. But nevertheless, people weren't too worried about valuations. It was merely about getting a much better comparative dividend yield. Now, the problem is that when bonds start to sell off, as we saw last week, then bond yields go up, and that makes high-yielding stocks less attractive. And so we've seen last week, particularly in Australia, a massive withdrawal of overseas funds that's been propelling this high yield, this demand for high yield stocks in Australia. So the question is, and we don't have the answer to this yet, is this a major a trend change in bonds, or is it like what happened in 2013 when Bernanke first signaled that they would be putting rates up? Bonds sold off sharply, but that only lasted for a week or two, and then everything just went back to normal, and people started buying bonds again. Bond values went up, yields went down, and everything went back to normal. We don't know the answer to that question yet, but certainly this was a very sudden and severe and unexpected sell-off in bonds. Now, if we look at American stocks, the S&P 500 index, despite the volatility, managed an 8-point rise on the week, but it was a pretty wild ride, and stock values fluctuated over quite a broad range. Now, it was capped off on Friday night by what I would describe as a Goldilocks jobs report. The jobs were not too weak, not too strong. They were just right in the middle, and that certainly gave investors in America the courage to basically, go back in and buy stocks. So the US economy it's not great, but it's doing okay, but it's the best in the world. So we really are in a very precarious position in a lot of areas. You look at Europe; they've certainly got their problems, although there are some pockets of improvement there, particularly with Germany, the Netherlands, Spain, France, not so much. But certainly there are some better signs in Europe. Japan is still in trouble. China could be in trouble. We don't know the extent of that yet. So, it's a pretty mixed tale around the world. Stock valuations in America I would describe as being reasonable. They're not, again, at an index level, they're not cheap, they're not expensive. But it's a stock picker's market. If you're trading the index or you're trading a broad-based market, then I'm not sure you're going to make a lot of progress. It's very much about individual stock picking. Now, by comparison, however, the Australian ASX 200 index was down by 180 points on the week, so it got absolutely smashed. And that's on top of 120 points the week before. So 300 points we've lost in back-to-back weeks. And if you think back just 2 weeks, people were talking about when it was we were going to break 6,000 like it was an absolute given. Now, with the banks having sold off and the banks being such a large component of the ASX 200, you'd have to say that there's no foreseeable probability of the Australian index breaking 6,000. So what caused the bond sell-off? Look, there's a lot of mixed reports. My view, the most logical and likely cause is that there was there was some trigger. I don't really know what that is, but it was you've got a lot of major players in the bond market that have been pushing those bond prices higher for so long, and they're very highly leveraged. And all it took was a bit of a reversal, and then everyone had to stampede out. So to me, this was not, because this sell-off defies logic. The logic of the fundamentals, the actions of the central banks, this sell-off in bonds is absolutely contrary to those fundamentals. So it shouldn't be happening. The fact that it is says to me that the people involved are being forced to sell. They're not selling because they think there's a significant change in the fundamentals either has happened or is coming. I think a lot of them were forced to sell. So therefore, it's hard to tell how far this will run. It's unpredictable because it's not based on logical fundamentals. So we'll just have to wait a few weeks to see how it plays out. So what are the implications for our stocks? Well, look, the severity of the sell-off in Australian banks and other high-yielding stocks makes it highly unlikely that life is just going to go back to normal in a couple of weeks. When you get savage sell-offs of that dimension, and we'll have a look at the finance index for Australia in just a minute, it makes it very unlikely that life goes back to normal quickly. So I really have some concerns about the Australian stock market, I must say, and certainly the Australian economy. So let's look at some charts. This is the S&P 500. If we pan back, in fact, let's just go back one and look at the monthly chart that we've been looking at for some time. There you can see absolutely no trend change in American stocks whatsoever. The index on a monthly level has been overbought for some time, but it still continues to grind higher. If we then go to the daily, you can see that over the last, let's say from mid-February, so about 2.5, getting up towards 3 months, the index has done nothing. It's just been in this tight range. It's just been coiling in an ever-tightening spiral between roughly 2040 and around 2120. We're back up to the top of that range again. We've had this 1, 2, 3, and this is the 4th go at it. If it's going to break, then this would be the time to happen. If you look at normal patterns, it's be incredibly rare for this to have another 4th crack at breaking the resistance level with these all-time highs. I think there's a very good chance it'll break through this time. So that's the American market. To me, it looks quite positive. However, if we go to the Australian market, so this is the ASX 200. You can see a huge 2-week sell-off, completely rejected from 6,000. And you can see in the last 3 days, very, very strong downdraft in the Australian market. Wednesday, Thursday, and even Friday sold off when Thursday was pretty good. Thursday night was pretty good in the US. So against the US going up on quite nicely on Thursday night, the Australian market still sold off. This is overseas money going home, and as I said, we'll have to wait and see how far the extent of that is. If we look at the finance index, you can see just the savageness of this sell-off in banks. Now, they are oversold, no question, so you'd have to expect a little bit of a short-term blip upwards. And how far this runs and how it does it will give us a good clue as to where to for the Australian market from here. But yeah, certainly interesting times for the Australian market, that's for sure. Now turning to commodities, gold really doing nothing. It was up $9 to 11.88, but it hasn't moved for quite some time, and it's just a frustrating lack of net movement. I've talked in the past about why that is and what would be required for the price of gold to go up. Just to recap, it's two things. Either the US dollar needs to go down so we get a currency effect, or we need to get some sort of systemic financial crisis around the world that causes people to run for the safe haven of gold. And it's hard to see either of those things occurring. So for me, the precious metals market, it's not a good reward for risk. I think you should absolutely stay out of it. And if we have a look at the actual charts for gold, if we look at gold on a weekly basis, you can see just how little net movement there has been in the last 3 or 4 months, really. And you can see we do have a declining wedge there on a weekly chart. Therefore, the odds are that, I'm not saying this will happen, but the odds are that the price of gold will break to the downside. And that then targets somewhere around about $1,000. So that's just the situation with gold as it stands now. Now, turning to other commodities, copper was steady at 290. But look, there's been a surprising rebound for many commodities, all the base metals and oil and even iron ore to a degree. And I really don't get the rebound because it's greater than, yes, the American dollar's gone down a bit, but the rebound is greater than the American dollar has gone down. And that's suggesting that the global economy is suddenly improving, that supply and demand in commodities is suddenly changing, and I just don't see that. So not quite sure what's going on with commodities. Probably we've just got some very large players who are trying to front run a possible trend change, but there's a fair chance they're going to get their fingers burnt. Crude oil steady at 59. Has the supply and demand situation for oil changed around the world? Again, I can't see it. I'm not saying that oil will go down much from here, but I can't see the basis for it to go up either. So some very interesting things happening in bond markets, commodity markets, and ultimately that always, of course, goes through into stock markets. There's the spot copper chart. So just a little plateau for the last week. So just to wrap it up, overall, local stocks, extreme caution. I'm very light on the Australian market at the moment. I have very little exposure, and I'm extremely concerned about most parts of the Australian market. There are some that, particularly with some recent pullbacks, still offer some opportunities, and members know where those opportunities are and the stocks involved. But the rest of the market, you just got to be careful, and I'd be holding a fair proportion of cash in the Australian market. On the other hand, the odds favour a US index breakout, in my view, and great stocks will continue to outperform whatever the index does. The really good stocks will do even better than that, and most won't, and that's just the reality. So it's very much a stock picker's market. So if you would like to get some assistance with your trading or investing, if you're not already a member of Specialist Share Education, there is information on our website. There's my email address. I'm always happy to be in contact with people. And look, my overall view is still the same. I think 2015, particularly overseas, is likely to be a net positive for stocks. And I still think there's great opportunity. Volatility creates more opportunity, so I think that's good. But it's harder to work with. Obviously a nice steady incline market is quite easy to work with. When it gets very volatile and it's diving all over the place, it's harder. But because of the swings, there's also more opportunity for profit. So fascinating time. Talk to you next weekend. Cheers.